Welcome to the deep dive. Okay, let's just say it. The stock market lately feels a bit like a roller coaster, doesn't it?
Yeah, definitely more ups and downs than we've seen for a bit. It can be pretty unsettling.
It really can, even if you're used to investing.
Yeah.
Now, you shared this really interesting piece from the Motley Fool, and it highlights some ETFs they think could be, well, let's say no-brainer moves for passive income, especially with all this market uncertainty.
Exactly. The article really zooms in on 3 specific ETFs. Each one has a slightly different approach, but the idea is they might be worth looking at right now.
Right. So our mission for this deep dive is what? To kind of pack those.
Pretty much. We want to get under the hood, understand why these 3 are being suggested, and pull out the key insights for, generating potential income and maybe buffering your portfolio a bit when things are choppy.
Okay, sounds good. So first up on their list is the JPMorgan Equity Premium Income ETF. The ticker is JEPI.
Yep, JEPI.
And the article frames it not so much as chasing huge growth, but more about consistency. Is that fair?
That's definitely the core idea. JPI's strategy is, well, it's focused on seeking lower volatility returns and consistent monthly income.
Okay, monthly income.
Right. And the article's pretty clear about the trade-off. You might give up some of the really big gains if the market just takes off like a rocket.
Yeah.
But the flip side is you potentially get that more reliable income each month, plus maybe some protection if the market slides.
So like steady singles instead of swinging for the fences.
Exactly like that, yeah. And the performance they mentioned kind of backs this up.
Oh, yeah. How so?
Well, JPI was actually outperforming the S&P 500 for a good chunk of the year, right up until that April downturn hit the market.
Okay.
And even though JPI went down in April too, it ended up negative for the year. At that point, its outperformance compared to the S&P 500 actually increased during that dip.
So it sort of did what it was supposed to do, cushion the fall a bit better than the broader market.
Precisely. It seemed to offer some of that downside protection it aims for.
So why does the article suggest now might be a good time? What were their points?
Okay, so there were a few key things. First, when the article was written, JEPI was apparently trading at a slight discount to its NAV, its net asset value.
Right, the value of its holding.
Exactly. Second, they highlighted a trailing dividend yield of almost 7.5%.
Wow, okay. That's noticeable.
It definitely catches the eye, but maybe the most unique part they talked about is JEPI's use of derivatives.
Derivatives. Okay, that word can sometimes make people nervous. How are they using them here?
Yeah, it sounds complex, but the basic idea, as the article explains it, is that they use things like selling call options, specifically equity-linked notes or ELNs, which contain options.
Selling options.
Right. This generates income for the fund that helps fuel the high dividend yield, but it can also cap some of the upside if the stocks underlying those options rally strongly. It's a strategy designed to make money from volatility or lack thereof and provide income even if the market goes sideways or down moderately.
Gotcha. So it generates income, but potentially limits big gains. It's that trade-off again.
Exactly. So the article's take is if you're maybe a bit worried about markets declining moderately or just moving sideways this year, JPI could be something to look at for that steady income and potential buffer.
Makes sense. It really comes down to what you're prioritizing, doesn't it?
Yeah.
Potential big growth versus more predictable income and some protection.
That's the core question, yeah. What matters more to you right now?
Okay, let's switch gears. The second ETF they covered was the Vanguard Utilities Index Fund ETF. Ticker VPU.
VPU, right. Utilities.
Now, utilities, electricity, water, gas, these are things people need regardless of the economy, generally speaking.
That's the fundamental appeal. Utility companies tend to have, pretty consistent revenues and cash flows. Demand doesn't usually swing wildly.
Because we all need to keep the lights on.
Exactly. So in times of economic uncertainty or market volatility, investors often gravitate towards utilities for that perceived stability. They're seen as more defensive.
And VPU basically bundles a lot of these companies together. What specifics did the article mention?
Well, they noted a 30-day SEC yield of 2.9%. Solid income, and importantly, a very low expense ratio, just 0.09%.
Oh, that is low. That Vanguard specialty.
It really is, and that low cost means more of the return actually gets to the investor over time. As for what's in the fund, electric utilities are the biggest piece, around 62%.
Okay.
But it also holds natural gas utilities, water utilities, kind of diversifying within that broader utility sector.
Any specific company names mentioned? just to get a feel for it.
Yeah, they listed the top 3 holdings: Nexstar Energy, Southern Company, and Duke Energy.
Big players.
Huge players. Those 3 alone make up over 25% of the fund's weight. So a definite focus on major electric utilities.
And performance-wise, how did the article say VPU has done recently?
This was quite striking. They highlighted that over the past year, VPU had a total return of over 26.6%.
Wow, 26%?
Yeah, and they compared that to the S&P 500's total return over the same period, which was only 5.9%.
That's a massive difference.
It really is. Now, the crucial caveat always is that past performance is no guarantee of future results. We have to say that.
Of course, of course.
But still, that kind of outperformance during a tricky market period, well, it certainly makes the case for VPU if you're looking to potentially reduce volatility and get that steady income.
So the picture the article paints for VPU is one of sort of defensive stability, a way to maybe sleep a little better at night if the market's choppy while still collecting dividends.
That sums it up well. It's about finding sectors that tend to be more resilient when the wider market hits turbulence, which, again, prompts a thought. How much do you value that kind of stability right now?
Right. Okay. Third and final ETF from the article. The Vanguard Energy ETF, ticker VDE.
VDE. Yep.
Now, energy sounds like it's been quite the opposite of stable lately, based on the article.
Yeah, that's a key point they made. Energy was apparently flying high, a top performer in the first quarter of 2025.
Okay.
But then, bam, April hit and it became the worst performing sector, a really sharp turnaround.
Oof. Any reasons given for that sudden drop?
The article mentioned a couple of big worries that seemed to hit the sector. One was concern about potential tariffs slowing down the economy.
Which would mean less demand for oil and gas.
Exactly. Lower demand usually means lower prices. The second worry was talk about OPEC plus potentially increasing oil production.
More supply. Also potentially pushing prices down.
Right. A potential supply-demand imbalance concern.
But the article didn't just say avoid energy, did it? It framed this drop as an opportunity.
It did, particularly for investors with a longer time horizon. The thinking is maybe this sell-off has made some quality energy companies cheaper, presenting a potential value opportunity.
And VDE gives you broad access to the U.S. energy sector.
Correct. It holds a mix of companies across the whole energy chain. You've got your upstream, the explorers and producers, midstream, the pipelines and storage, and downstream, the refiners and marketers.
Could you give some examples like you did for VPU?
Sure. The big integrated giants are in there, like ExxonMobil and Chevron. They make up a pretty hefty chunk, actually, around 38% combined.
Okay, wow.
Then you have major exploration and production companies like ConocoPhillips, EOG Resources, midstream players like Williams Companies, Wanihoke, Kinder Morgan, Phillips 66 on the downstream side, even oil field services like Schlumberger and LNG with Cheniere Energy. It's pretty well spread across the different sub-industries.
Gotcha. And the article also talked about dividends in energy, right? That's often a big part of the story there.
A very big part. Many established energy companies are known for returning cash to shareholders via dividends. The article specifically called out ExxonMobil and Chevron for their incredibly long streaks, like 42 and 38 years, respectively, of consecutive dividend increases.
That's impressive consistency, especially in a cyclical sector like energy.
It really is. And the benefit of investing through an ETF like VDE, the article suggests, is diversification. If one company hits a rough patch and has to cut its dividend, it doesn't sink your entire income stream from that sector.
Right, the ETF spreads the risk.
Exactly. Plus, VDE also has that low Vanguard expense ratio, 0.09%, and they mentioned you can invest with basically just $1.
Makes it accessible. Did they give any valuation metrics?
Yeah, they noted a price-to-earnings ratio of around 13.3 for the fund and a dividend yield of about 3%. The implication was that this could look attractive to value-oriented investors seeking income.
So, summing up the VDE angle from the article, volatile sector, yes, but the recent dip might offer a value entry point, especially given the dividend potential and diversification through the ETF.
That seems to be the core argument. If you're okay with the inherent volatility of energy and have a longer view, the article positions VDE as a potential way to capture value and income, which naturally leads to the question, how comfortable are you with sector-specific bets, even with potential rewards?
Okay, so just to recap this deep dive, we've dug into this Motley Fool article looking at 3 ETFs they flagged as potential passive income plays in, well, these choppy markets. We had JPI focusing on lower volatility and that monthly income using that derivative strategy.
Right, the income and downside buffer approach.
Then VPU, the Vanguard Utilities ETF, banking on the stability of that sector for a consistent, if maybe modest, returns and dividends.
The defensive stability play.
And finally, VDE, the Vanguard Energy ETF, presented as maybe a value opportunity after that recent sector sell-off, with a strong dividend component.
Yep, the potential value and income angle in a cyclical sector. 3 quite different approaches, really.
Absolutely. And as we always have to stress, this was just exploring the ideas in one article. Any decision has to fit your own personal financial picture, your tolerance for risk.
Couldn't agree more. You absolutely have to do your own homework and see if any of these, or frankly none of these, fit your specific goals and situation.
Definitely. So maybe the final thought to leave folks with is this. Thinking about those 3 strategies, the income buffer focus at JPI, the stability of VPU, or the value income potential in the more volatile energy sector with VDE, which kind of approach feels most aligned with how you're thinking about passive income in the market right now. Something to mull over.